I've said it before and I'll say it again. The first rule of compounding is to never interrupt it unnecessarily. And the fastest way to interrupt compounding is to lose money. It sounds obvious, almost insultingly so, like telling someone not to stick their hand in a fire. Yet the world is full of people with burned hands. I've been investing for more than half a century. I've seen markets rise, collapse, recover, and collapse again. I've seen geniuses go broke and ordinary people quietly become wealthy. And if I had to boil all those years down to one simple principle, it's this. The people who survive are the ones who avoid stupidity better than they chase brilliance. When I was a kid growing up in Omaha during the Great Depression, the word crash wasn't just something you read about in the papers. It was reality. Men who once wore fine suits were selling the apples on street corners. Families who'd spent years building homes lost them overnight. You could buy a good farm for the price of a used car. The lesson was painfully clear. If you took on too much debt and the tide went out, you drowned. If you stayed conservative, you survived. I watched families destroyed not by bad luck, but by overconfidence. They assumed tomorrow would look like yesterday. It didn't. That experience cured me of any illusions about human rationality. People don't learn as quickly as they should. Fast forward to the 1970s. Inflation was devouring savings. Stocks were collapsing. Oil prices were exploding. Once again, the smart people, the ones with fancy degrees and expensive suits, were losing fortunes because they borrowed too much, believed too much, and expected the world to reward their optimism. I wasn't brilliant. I was cautious. I avoided debt. I ignored hot tips. And I refused to chase whatever was fashionable that week. Because I avoided losing big compounding work quietly in the background, year after year, decade after decade. It's worth repeating. Not losing is more important than winning. People hate hearing that. They want to win big, to double their money by Tuesday, to post screenshots of their trading accounts. That impulse, the need to win fast, has destroyed more wealth than poverty ever could. Look at Las Vegas. The lights on the Strip aren't paid for by winners. They're paid for by losers who thought they had a system. The stock market is just a bigger, better dressed restaurant. I remember once investing in a company that looked cheap, a real cigar butt deal, one puff left, maybe a little smoke for free. Well, the smoke was free, but the stink stayed with me years. I learned that buying garbage just because it's cheap doesn't make it less garbage. Cheap junk is still junk. That mistake cost me money, but it taught me something more valuable than any textbook ever could. The price of avoiding stupidity is always lower than the cost of fixing stupidity. So if you want to know how to never lose money, start by cutting out the obvious disasters. Don't borrow what you can't repay. Don't buy what you don't understand. Don't take advice from people who make money selling advice. And never ever believe you're smarter than the market. You can build a fortune simply by surviving. Warren and I never tried to get rich quick. We just tried not to go broke. That small difference repeated for decades turns into something extraordinary. Forget brilliance. Forget trying to outsmart everyone in the room. Just make fewer dumb mistakes. That alone will make you rich. And if you don't like the sound of that, go ahead, chase the next hot stock tip. The market will be happy to take your money. Now, if you really want to ruin your life, then your portfolio envy will do the job faster than any market crash. Envy is the dumbest sin because it doesn't even make you feel good. Lust can be fun. Gluttony at least tastes good. Pride feels nice for a while. But envy is like drinking poison and waiting for the other person to die. I've watched perfectly decent, successful people turn miserable because someone else did slightly better. Their neighbor drove a nicer car. Their classmate bought a bigger house. Their colleague got rich faster. Suddenly they weren't content anymore. They started taking stupid risks just to catch up. That urge destroys investors. Instead of sticking to sound principles, they chase whatever seems to be working for someone else. Tech stocks in the 1990s, real estate in 2006. Crypto in 2021. Different decades, same stupidity. Warren and I never wasted time on envy. We didn't care if someone else doubled their money while we were sitting still. We knew that sitting still with the right assets was often the smartest move. It's not easy, but it's simple. Back in the dot-com bubble of the late 1990s, everyone was bragging about internet stocks. We looked like fools for not joining. Some of those stocks went up tenfold in a single year. Our friends were paper rich, while we looked boring and old-fashioned. A couple of years later, most of those paper fortunes turned to dust, and boring old Berkshire Hathaway kept compounding. Envy cost those people fortunes. They weren't satisfied with their own game, so they copied someone else's badly. They thought they could leapfrog their way to glory. Instead, they jumped off a cliff. Got rich men who couldn't enjoy their yachts because someone else had a bigger one. That's not success. That's slavery. Someone will always be getting richer faster than you. So what? That attitude will keep you sane. It might even keep you alive. The truth is, envy-driven moves often look like brilliance in the short term. You get lucky, people applaud, you feel smart, then the tide goes out, and suddenly you're standing there naked, broke, and embarrassed. You don't need to win every race. You only need to avoid losing your shirt. The person you envy today might be bankrupt tomorrow. If you're sensible, you'll still be standing. So stop looking at the scoreboard. Focus on your own game. The race is long, and most runners won't finish. Your only job is to stay in it without tripping over your own stupidity. That's how you win. I've made plenty of mistakes. Some small, some expensive, and one or two that probably cost me a fortune. People like to imagine that Warren and I sat in some quiet office making perfect decisions all day long. That's nonsense. We screwed up plenty. The only difference is we avoided the kind of screw-ups that could wipe us out completely. One mistake I still think about was underestimating how valuable certain businesses could become if left to compound for decades. We passed on things that seemed too expensive at the time. Coca-Cola before we graduated, for example. It wasn't a disaster because we eventually did buy Coca-Cola, but we could have made a lot more if we'd recognized its quality sooner. That's a common error among investors, being obsessed with the price tag and forgetting the quality of the business. Buying garbage because it looks cheap, or ignoring greatness because it looks expensive. Both are costly. Let me give you another story. Years ago, I bought into a so-called cigar butt company. It looked like a bargain. One last puff left, maybe a little profit if I was lucky. The numbers were cheap, and I thought I was being clever, but the business was dying. I made a little money, then lost it, and worst of all, wasted years that could have been spent on something better. That mistake cured me of cigar butts. They may give you a free puff, but they leave a bad taste. It's far better to pay a fair price for a great business than a cheap price for a lousy one. I can almost hear young investors saying, but Charlie, I don't want to overpay. Well, here's the thing, overpaying a little for quality is still safer than underpaying for garbage. Garbage goes to zero, quality compounds. The real mistake isn't paying 20% too much for Coca-Cola. The real mistake is never buying Coca-Cola because you were too busy hunting for bargains in the trash heap. Now, don't misunderstand me. Discipline matters. We didn't throw money at anything with a shiny brand. But when we saw a fortress business with staying power, we learned not to get too cute. That lesson cost me millions to learn. The truth is, the big money isn't in the buying or the selling, it's in the waiting. And you can't wait on a lousy business because time is the enemy of garbage. Time is only a friend of great businesses. So when people ask me, Charlie, what's the worst mistake you ever made? I usually tell them it wasn't the money I lost. It was the money I never made because I realized the obvious. If you want to avoid losing money, don't just avoid disasters. Avoid wasting decades on mediocrity. That's the quiet mistake that robs more investors than any market crash ever will. The market punishes the impatient, but It also punishes the blind bargain hunter who thinks price matters more than quality. It doesn't. In investing, you don't get paid for being clever. You get paid for being consistently not stupid, realizing that early is worth millions. Most people lose money not because of bad luck, but because of overconfidence. They think they know more than they do, and they act on it. I've watched men sit in boardrooms absolutely certain they could outsmart the world. They'd say things like, "This time is different," or "the old rules don't apply anymore." Every time I heard that, I knew trouble was coming. Confidence is fine. Arrogance is fatal. Most people don't realize how limited their circle of competence really is. They read a few articles, talk to a broker, maybe watch a TV pundit, and suddenly they think they understand oil markets, tech stocks, and foreign currencies, all before lunch. That's how fortunes vanish. Warren and I stayed rich by admitting what we didn't know. It sounds dull, even weak, but knowing your limits is one of the most powerful edges in investing. Take airlines, we avoided them for decades. They looked like death traps, capital-intensive cyclical union problems, fuel costs, all stacked against investors. We knew we weren't smart enough to tick the winners in that mess. So we stayed out. That one decision saved us from a century of disasters. Of course, later on, we bought some airline stocks, thinking the industry would change. That was a mistake. The business hadn't changed. We just let our guard down. Fortunately, we didn't bet the farm. We lost a little, shrugged, and moved on. Here's the lesson. Overconfidence makes you double down when you should walk away. Admitting ignorance makes you live to fight another day. One of the most dangerous sentences in investing is, "I can't miss." The moment you think you can't miss, you already have. Remember the dot-com bubble? Everyone thought they were a genius. College kids day trading from dorm rooms, taxi drivers giving stock tips, people saying things like, "Profits don't matter anymore." That kind of delusion is fueled by overconfidence. And it always ends badly. I don't mind looking stupid for avoiding something I don't understand. I do mind looking stupid for betting big on something I never understood in the first place. The cure is humility, not the fake kind where you pretend to be modest while secretly thinking you're brilliant. Real humility, the kind that says, "I don't know and I don't need to know." That's the real secret to never losing money. Admit what you don't know, and don't play games outside your circle of competence. You don't need to swing at every pitch. You only need swing at the ones you understand. If you want to avoid losing money, get rid of the idea that you need an opinion on everything. Nobody cares what you think about oil futures, crypto, or interest rates in Japan. If you don't in it deeply, sit still. That discipline will keep more money in your pocket than 1,000 clever opinions ever could. One big reason people lose money is that they think like employees instead of owners. They optimize for the next quarter, the next promotion, or the next bonus, not the next 20 years. Careerism makes people play it safe in all the wrong ways. They protect their job instead of protecting the business. They protect their ego instead of protecting their capital. I've sat on enough corporate boards to see how this works. Executives love to talk about strategy and growth initiatives, but what they really care about is whether their stock options will vest if reality catches up. That's why companies spend billions on buybacks at the top of a bubble, then cut investment when the market collapses. They're playing for applause, not survival. Warren and I never thought like that. We thought like owners. We didn't care if a decision looked good next quarter. We cared whether it would still look good 20 years later. Take See's Candies, for example. When we bought it in 1972, plenty of analysts said we overpaid. If we'd been thinking like career executives, we'd have worried about what the press or analysts would say the next quarter. But we weren't playing that game. We were playing the compounding game. Over the decades, he's generated more cash than anyone imagined, not because we micromanaged it, but because we left it alone to do what it already did well. That's what happens when you stop paping like an employee chasing validation and start thinking like an owner building endurance. Ownership changes your perspective. It forces you to think in decades instead of days. Now, one thing that really separates great investors from mediocre ones is patience. Everyone talks about it. Few actually practice it. The irony is that patience feels uncomfortable because the world rewards activity. People want to be doing something. But in investing, doing nothing is often the smartest move. When we buy a wonderful business, our favorite holding period is forever. That doesn't mean we never sell. It means we only sell when the fundamental story changes, not because we get bored or scared. Time, when combined with quality, becomes an ally that works harder than any analyst or trader ever could. People often ask me, Charlie, what's the biggest secret behind long-term success? And my answer is always disappointingly simple. Stay rational and stay in the game. That's it. Not emotionless, not fearless, just rational enough to avoid the big dumb mistakes that wipe most people out. The world loves complexity because it sounds intelligent. But the truth is, most of the great lessons in life and investing are painfully simple. Avoid stupidity, avoid envy, avoid debt, avoid arrogance. The rest takes care of itself. Most people can't do it because simple doesn't mean easy. It takes character to sit still while everyone around you is losing their minds. It takes discipline to keep your head when everyone's chasing the next miracle or the latest speculative craze. I often say, if you can't handle watching your portfolio drop 50% without losing sleep, you shouldn't own stocks. Markets will humble everyone sooner or later. The only question is whether you learn humility before the market teaches it to you the hard way. I've seen brilliant men wiped out because they thought risk was something you could eliminate with math. They built models, charts, and theories, but they forgot about human nature. Fear and greed will always overpower formulas. You can't model emotion out of markets. The only real protection is temperament. Temperament beats intelligence every time. It's not about having the highest IQ. It's about keeping your emotions from wrecking your logic. If you can stay calm while everyone else panics or euphoric while everyone else goes insane, you've already won half the battle. And speaking of battles, remember, investing isn't a war against other people. It's a war against your own impulses. You are your own worst enemy. The urge to act, the urge to chase, the urge to prove you're right. That's what destroys returns. If you can learn to master those urges, compounding will do the rest. Slowly, quietly, invisibly, until one day people call you lucky. Luck favors those who survived long enough to let math and time do their work. Now, let me leave you with something I've said for years, because it sums up everything we've talked about. All I want to know is where I'm going to die. So I'll never go there. If you spend your life avoiding stupidity instead of chasing brilliance, you'll naturally end up at a pretty good destination. The irony of wisdom is that it often sounds boring. It doesn't promise excitement. It promises endurance. But endurance is what wins the game. It's what lets you stay solvent, stay sane, and stay compounding while everyone else is busy blowing themselves up. So here's the real takeaway. Don't focus on being the smartest investor in the room. Focus on being the last one standing. Compounding doesn't reward brilliance, it rewards survival. If you can stay rational, patient, and humble long enough, everything else takes care of itself. And if you ever feel tempted by envy, arrogance, or the illusion of certainty, just remember somewhere out there, someone's making a terrible decision that will make you look like a genius simply because you make it. That's the beauty of avoiding stupidity. You don't need to do something amazing. You just need to avoid doing something disastrous. That's how you win, by staying in the game, by surviving, by letting time and discipline quietly build what impulse and greed constantly destroy. That's how you never lose money.